As a blogger and an avid investor, I understand the importance of understanding the jargon used in the investment world. In this blog post, I will explain 25 of the most commonly used terms in the investment world to help you navigate the world of investing with more confidence. Understanding these terms will aid you in making informed investment decisions and potentially achieve your financial goals. Asset. An asset is anything that has value and can be owned. Examples of assets include stocks, bonds, real estate, and commodities. Understanding the different types of assets is important in creating a well-diversified portfolio that can potentially maximize returns while minimizing risks. Diversification. Diversification is the practice of spreading investments among different asset classes or industries in order to reduce risk. By diversifying, investors can potentially mitigate the impact of any one investment losing value by spreading their investments across different types of assets. Risk. Risk is the likelihood of an investment losing value or not performing as expected. Every investment carries some level of risk, and understanding the risk associated with different types of investments is crucial in making informed investment decisions. Return. Return is the profit or loss made on an investment, usually measured as a percentage of the initial investment. When assessing the potential returns of an investment, it's important to consider both the potential upside and downside. Bull market. A bull market is a market in which prices are rising and investors are optimistic. During a bull market, investors tend to see positive returns on their investments and may be more likely to invest in riskier assets. Bear market. A bear market is a market in which prices are falling and investors are pessimistic. During a bear market, investors tend to see negative returns on their investments and may be more likely to pull back on riskier assets. Portfolio. A portfolio is a collection of investments held by an individual or institution. Creating a well-diversified portfolio that suits your risk tolerance and investment goals is crucial in achieving long-term investment success. ETF. ETF stands for Exchange Traded Fund, which is a type of investment vehicle that tracks a certain market or sector. ETFs can provide investors with exposure to a specific market or sector without the need to buy individual stocks. REIT. REIT stands for Real Estate Investment Trust, which is a company that owns and operates income-producing real estate. REITs can provide investors with exposure to the real estate market without the need to buy physical property. Mutual fund. A mutual fund is a professionally managed portfolio of stocks and bonds. Mutual funds can provide investors with diversification and the potential for higher returns than investing in individual securities. IPO. IPO stands for Initial Public Offering, which is the process by which a private company raises capital by issuing shares of stock to the public. Investing in an IPO can provide investors with the opportunity to invest in a company at the early stages of its development. ROI. ROI stands for Return on Investment, which is the gain or loss made on an investment expressed as a percentage of the initial investment. ROI is a key metric used to assess the performance of an investment. Hedging. Hedging is a strategy that aims to reduce the risk of an investment by offsetting potential losses with other investments. By hedging, investors can potentially mitigate the impact of any one investment losing value. Leverage. Leverage is the practice of using borrowed money to increase the potential return of an investment. While leverage can increase potential returns, it can also increase risk. Derivative. A derivative is a financial contract that derives its value from an underlying asset, such as stocks. Blue chip stocks. Blue chip stocks are stocks of well-established and financially stable companies that have a history of consistent earnings and dividends. These stocks are considered to be less risky compared to other stocks. Growth stocks. Growth stocks are stocks of companies that are expected to grow at a faster rate than the overall market. These companies may reinvest their earnings back into the business rather than paying out dividends. Value stocks. Value stocks are stocks of companies that are trading at a lower price compared to their intrinsic value. Value investors look for undervalued stocks that they believe will increase in value over time. Margin trading. Margin trading is the practice of borrowing money from a broker to buy securities. This allows investors to trade with more money than they have in their account, but also increases the risk of losing more than the initial investment. Short selling. Short selling is the practice of selling a security that the investor does not own with the expectation that the price will decrease. If the price does decrease, the investor can buy the security back at a lower price and make a profit. Options trading. Options trading is the practice of buying or selling options contracts, which give the holder the right but not the obligation to buy or sell a security at a set price. Options trading can be used for both speculation and hedging. Futures trading. Futures trading is the practice of buying or selling a contract for a specific asset at a set price and delivery date. Futures trading is often used to speculate on the future price of commodities. Commodities. Commodities or raw materials are primary products that can be bought and sold, such as gold, oil, or wheat. Commodities can provide diversification to an investment portfolio and can potentially act as a hedge against inflation. Foreign exchange, Forex, foreign exchange, also known as Forex, is the trading of one currency for another. Forex trading can be used for both speculation and hedging against currency risk. Private equity. Private equity is the practice of investing in private companies, typically through a buyout or a minority investment. Private equity investments can provide high returns but also have a higher level of risk. Investing can be a complex and challenging endeavor. It is important to do your own research, consult with financial advisor, and to understand the terms used in the investment world. With the knowledge of these terms, you will be better equipped to make informed investment decisions and potentially achieve your financial goals. Achieve your financial goals.